All right, how's everybody doing out there? Everybody having a good day too? Woo. That's amazing. Before we get started, I just wanted to take a little survey. How many entrepreneurs do we have in the room? Raise your hand. Awesome, great to see. How many investors? Great. How many want to be either way? All right, a few. Well, we hope we can convince you today. My name is Saxon Baum, and I'm a partner at Florida Funders. We're the most active VC in the Southeast and in the state of Florida. And really today we have an amazing panel set up. We're going to talk about, from the VC lens, what we're seeing in market. So from an investment standpoint and from an entrepreneur standpoint, what you all could be looking for and be thinking about whether it comes to fundraising and or running your businesses. So to kick it off, why don't we have our amazing panel introduce yourselves, a little bit about your firms and what you guys focus on.
Hi everyone, my name is Samara Hernandez and I'm a founding partner of Chingona Ventures. For those of you that don't know, Chingona means badass woman in Spanish from Mexico, and we're investing in badass founders at the earliest stages. So we're pre-seed mainly, so our goal is to be the first and largest institutional check into any company. We focus on fintech is the biggest sector, health and wellness, ed tech, and food tech. We're based in Chicago, but invest all over the United States, and we have 2 deals here in Miami.
Hi everyone, my name is Liang Wu. I am a co-founder at 1126 Capital. Our thesis is what we call investing in the evolving internet. So with new technologies like Web3 and AI, we think it will continue to disrupt, even Web2 companies and all of that. So we love backing founders building in some intersection, especially really focus on a couple areas we love, like empowering the creator, empowering the user, empowering the individual. We invest in pre-seed and seed, and we mainly focus on areas where we think in addition to capital, we could also help the founders as they build their companies.
And hey guys, I'm Casber. I'm a partner at Sapphire Ventures. At Sapphire, we focus mainly on growth stage, mainly enterprise B2B SaaS, manage about $10 billion, investing out of the latest $2 billion fund. So, think about Series A would be probably the earliest entry point, all the way up to pre-IPO. Internally we talk about this mantra about partnering with companies of consequence, so companies that could go IPO or achieve a meaningful M&A outcome. Yeah,
awesome.
Excited to be here.
Awesome, well, happy to be here. Thank you guys so much. I want to talk a little bit about valuations. This is a hot topic for everybody right now. We're in an interesting market. We have pre-seed all the way through growth. So we'd love to just get everybody's sort of what you're seeing right now from a valuation standpoint. How's that changed with the current market conditions?
Mm-hmm. Yeah, so at the fourth quarter of last year, we took a poll because we track every company that comes through the door. And we saw, at least on the pre-seed and seed stage side, not only had valuations not gone down, they've actually went up slightly in the fourth quarter. So what that's showing is that there was still a disconnect with what was happening in the public markets and the growth stage markets and what was happening in the early stage. And that makes sense because typically at the early stage, it takes about 9 to 12 months from what's going on in the public markets to reach the private markets and then super early stage. First quarter, things started to come down a bit, and not a lot though. It's slight or flat. And this quarter, we're actually starting to see a slight uptick again, which is really interesting because you would think that it's going down. And what that affects, how that's affected in the market is that the expectations of where founders want to raise is still not fully aligned with what investors want for the risk that they're taking, for the amount that the company needs to raise. And so we're finding that there's a slowdown in deals. We're finding that, of course, it's taking a lot longer. But even if we do want to do a deal, the deal terms aren't aligning as much as they were in the past. And investors are just less willing to write, a 20 million cap on a pre-seed with no revenue, no product, no website, which was happening the last 2 years. So we're starting to see that. I'm not sure how that's going to change. And I will say this, deals are getting done. And we had an oversubscribed deal here in Miami get done in December, but the valuation and the terms made sense, and it went from a $1.5 million round to a $3 million round very quickly.
Awesome.
Yeah, one of the things I'll add is I think valuations are still kind of like fluctuating, so I don't think there's any like stability yet. To your point, it went down a lot, but then the good founders are good founders in any market, and they'll always want to believe their valuation is higher than what you want to present. So the other angle to all of this is the dance between good founders and good VCs, right? Where a good founder will still command a higher valuation, but as a VC, your bar now is a lot higher to say, is this actually a good founder? And the challenge in the early stage, which we both do, that's really challenging, is you don't really have a lot of signals. So you're still kind of doing the same bet, but the market has really kind of changed the game. But I think there is still this, top tier around like, how does the best VC work with the best founders? Because they both ask a lot of each other.
100%. I would say at the growth stage, things are pretty frozen, although I just did a deal and just wired yesterday, so pretty happy about that.
There you go, love to see that.
But it's, the analogy I use is, if somebody put up their house just for sale at 5 million and public market says your house is $1 million, like what you're gonna do is you're just gonna pull your house from the listing. You're not gonna sell your house anymore. And that's what's happening on the growth stage. And the other dynamic for the growth stage is also, there's a mark, right? There's a more established mark around the company's last round valuation. And that's psychological, and it's just hard for investors to go in and tell the founder, hey, your company is not worth that much. So that's a pretty big dynamic in terms of why sort of the growth stage market is pretty frozen right now. Yeah. And the other thing that's happening too is, most good companies have raised a lot of money in 21 and 22, right? And they could be great companies, but they haven't really grown into their last round valuation yet. So, with all that cash, I think folks should take more of a wait and see approach, which is why I think we've seen sort of companies that have hundreds of millions of cash on the balance sheet laying off, right? Do layoffs and restructuring and whatnot. And partially it's because they want to buy themselves some more time to grow into the valuation.
So great point. I want to piggyback off that, Casper. Over the last several years, obviously venture capital has been one of the hottest asset classes, and we've really seen sort of this growth at all cost be what's rewarded in the market. Grow as fast as you can, raise more money, and you will be rewarded. And that was really the goal for a lot of venture and private equity-backed companies. Is that still the case? Is that still being rewarded in the market? And if not, what are you all seeing that is being rewarded in the market from an investment standpoint? And what are you telling your portfolio companies to be thinking about in terms of operations, cash burn, those types of things?
Yeah.
Samara, please.
Yeah, so maybe it's just a Midwest thing, but for us, it was never grow at all costs, right? The last 2 years were an anomaly. I think it's a correction that needed to happen. And we were always focused on what's your path to revenue, what's your path to anything, right? Yes, there was investments that we made that had large communities, big sign-up lists, all that, but we were very intentional about revenue early on. Now, of course, last 2 years, things got a little crazy, and so people were flexible on a lot of different ways. I looked at my portfolio this morning and looked at to see which companies had the highest markups in our portfolio, were able to raise even in this environment. And those were the ones that had real revenue. Those were the ones that are break even, that had, went to profitability. That is being rewarded in this market. I think in the last 2 years it was rewarded, but it wasn't
it wasn't the key
the key piece, right? Yeah. Exactly. And so deals are getting done. There was 2 follow-on rounds that were oversubscribed in my portfolio, but they all were had large growth rates. They had real revenue, and there was a clear path to an exit, but also the founders themselves were able to choose their own destiny and would say, okay, well, we're not running out of cash in 3 weeks, so they had time to do all the due diligence that everyone needs to do. They had time to choose what VCs they would work with, and that's hard, I know, as a founder, because you don't always get a chance to do that, but that's what's really being rewarded.
Right. Yeah, one of the biggest things I'm seeing is this concept of just like, in a bull market, the dynamics are different, right? When you think of capital as part of the formula, you kind of just got to market and maybe the next day you have money, right? In a bear market, it's very different. And so I think the best founders, what I've seen is they're willing to kind of take the plan they made 2 years ago or a year ago, throw that out the window and actually play to this market, which I think is often something that's really underestimated. And so I see a lot of what I think of founders reverting to very basic first principles, right? So for example, if you build a product people like, usually it goes well, right?
That's typically how it works,
exactly,
right? Yeah, it makes sense.
Yeah, if you're in a world of the internet and you understand how distribution works, right, which is building a brand, thought leadership, working with the right partners, usually it goes well, right? I think what's hard is in a world where you have a lot of money, your thinking might say, great, I have to do distribution, I have to do marketing, let me hire 5 people to do it. Now you have to figure out how to do it by yourself, or maybe one person at best. And I think it's interesting because no one wants to be in a bear market, but if you look at the history of all big companies, they were built in bear markets. And I think the hunch I have is people are putting, the bar is higher, the challenge is higher, the question is who is stepping up. And I think it goes back to very basic first principles, and the scrappy founder, I still think is a try and test it archetype that will build a big company. And so those are the ones where we try to just lean in where we can to help. But I think you can't change the basics because they're tried and tested.
And are you guys taking more of an active role with some of those companies at this point?
Yeah, for me at least, outside of all of this, one of my passions is writing, so I do a lot of writing, storytelling, thought leadership. I've had a career in biz ops, strategy, and all of that. And so our pitch to founders is like we're biz ops for founders, because at the early stage you cannot hire an MBA who's done 5 years in consulting and afford that because you're raising smaller rounds, especially in this market. So we like to just stay in our lane. If a founder has a story to tell, we're not going to go dig in product unless we know something, but we could bang out a 1,000-word essay that explains what they're doing, and that's another way to help with distribution.
Absolutely.
So we do try to be more active, but we don't try to be the, I call it like armchair founder as a VC, where they have a product and it's like, oh, we think this button should look like this. I don't know if it should look blue or red. Like, I don't have that expertise, so I just stay away from that.
Founders know their business better than
exactly.
anyone. Always.
Exactly.
Yeah.
Exactly.
Absolutely.
Yeah, I mean, the only thing I would add on the efficient growth point is, the underlying statement about efficient growth is just growth is not created equal, right? I think the 2021, people are like, as long as it's growing, it's fine.
Yeah.
But the reality is a lot of those businesses, some of the high-flying businesses, they're not going to be long-lasting big IPO companies, right? You think about if a company gets to 500 million GAAP revenue, 21, let's just say they trade at 20 times, that's a $10 billion company. Today, they might trade at 3 times or 2 times, and that's a $1 billion company, right? That's a huge delta in between. So I think thinking from efficient growth, I think there are 2 levers here. One is just a structural business point about the business model side, and that's when investors come in and try to pick, right? Try to think about what sectors have long-term tailwinds. Does the market dynamic, is that conducive to create a big company? And some of them, it's like a talent thing, right? It's sort of, there's natural ceiling and constraint on how big of a company you can build in one single sector, and some companies run out of time, right? So that's just part of the reality of it. And the second lever, I think, is just things you can really control about, what do you do in this environment, and be smart about growth, and understand, like, if you put $1 in top of the funnel, how much you get, on the other side, right? So I think those are the stuff that we talk a lot, in the boardroom for our companies, and also talk a lot to our CEOs about.
So, Casber, for you, us early stage investors, a lot of the work that we do on the due diligence side is very qualitative. And now it's becoming much more quantitative, and we've become, I would say, a bit more conservative in the way that we're underwriting opportunities. In the later stages where you play, has this market changed the way that you guys are doing due diligence at all, or has it always been sort of that more quantitative side?
Yeah, it's a great question. I would say, first of all, I think the factors that matter the most on the growth stage and the early stage are the same, right? It's the founder to the team, market, and the product, in my opinion. The same thing, same dynamic. Because, again, I go back to the point, you can have a great looking business at 10, 20 million ARR, but it really doesn't matter. If I get it at $1 billion, I need my 4 or 5 billion company, and that company has to have all the qualitative factors to be a $5 billion company. It doesn't matter how fast we're growing right now, right? Obviously, growing fast right now, efficient growth right now gives me peace of mind, but it doesn't mean that I think they could scale to a $5 billion company. Yeah. So I think that's probably part one. The other part is, it's just, we do have more time now. I think 21, there's very much of a CAA agent.
Deals aren't getting done.
Exactly, the CAA agent model, right? We show up to a meeting and see what kind of shoes the founder's wearing, and like taking the guy out for wine tour or something, and here's a term sheet, sign on the term sheet, name a price. There's a lot of that going on, I would say. This year, I think, obviously, we steal for the best founders again. I keep thinking, when you think about every vintage, right, every year, there's probably 5 to 10 companies in B2B that you really want to partner with. So for those founders, if you feel like that's the opportunity, you just got to go for it, right? Like for us, the diligence process is, we do a ton of work, right? We know those folks since seed or pre-seed sometimes. I've known some founders who, were at Netflix and they were talking to me about, I want to start a company. And I'm like, I can't back a company, but here are 3 of my early stage friends that you want to talk to, right? So then 3 years down the road, 2 years down the road, I might back this person because of the pre-existing relationship. So to your point, the diligence part, a lot of it has gone from doing diligence at the deal point, for some people do no diligence at all, to sort of doing a lot of work pre-deal.
So I want to talk a little bit about vintage years. If you look back over the last, call it 10, 15, 20 years, some of the best returning funds came from 08, 09, and 2010, really when the economic downturn happened. How do you guys feel about the current market, the current vintage being 23, then 24? You guys excited for what you're seeing out there? I know we talked a little bit about valuations. What do you think about these vintage years over the next few years here?
Yeah, I mean, there's 2 parts, right? Part of it is if you have a portfolio that is raising and maybe they raise at really high valuations and they haven't hit their metrics, that sucks, right? We kind of know that path, and the companies are getting shut down sooner than they would in a normal environment, and that's just the nature of the business. But we're just starting to see that accelerated up front. On the other side, we closed our last fund last May. We have a fresh amount of capital.
Congratulations,
Thank
very
you.
exciting.
It was a good time to do a final close, but we're really excited about it. We see sometimes 100 deals per day come through our door, and we are very excited about what's coming through. And as we mentioned earlier, in these times is when these businesses get started. There's a lot of companies, unfortunately, the unfortunate part is that there's layoffs and there's shutdowns, but those engineers are then starting their own companies, and we're starting to see some of that. So that's something that we're really excited about. But again, it's not something, we're also being realistic and doing a lot more of the due diligence and managing that risk. But I think there's going to be a lot of great things coming out of it. And also, it's something that needed to be corrected. It's also something that people are going into it, not raising crazy amounts, raising what they need, proving it out, raising what they need, proving it out. And so it's an exciting time. If we don't get some of the SVB situations happening. Sorry if any SVB in the audience, but there's things that are coming up that we're like, really, it's a bad environment. But anyways, not to talk bad about SVB, but other things that I think are going to come up, and it's going to be unfortunate, but we'll weather through it. And founders are resilient and have a lot of grit, and so we're optimistic about this environment.
Awesome.
Yeah, I think I love the word optimistic. I think the best VCs have to be half skeptical, half optimist, and it's actually hard, right? Because you might be super excited that something will work out, but then you're like, wait, but is this real or not?
And your job is to say no.
Oh yeah, exactly. Right? Yeah, most of your job is to say no and write the email that, quite frankly, most people don't want to write. Yeah. But I think one thing that often, right now in the market, everyone talks about the market, but they don't talk about all this other stuff that's happening. Right, and I know, Saxon, you were going to talk about AI in a bit, but I think even pulling back a little bit, we live in a time where emerging technology, there's not only one, right? When the internet came out, the only thing around there that was usable was the internet. Now you have Web3, right? It's going through ups and downs. You have AI and all this other stuff happening in biology and all of that. So there's the market, which means generally capital dries up, it's harder to fundraise, but there's also the fact that productivity could go up a lot if you just know how to use some of the more cutting edge tools. Right, and so I think to your point about am I excited by this vintage? Totally, and I think what we will actually see is sort of this new age founder that is, again, traditionally I use the marketing example because that's what I hear a lot of is well, I don't know how to hire a marketer to write copy. Well, guess what? You could actually write 80% of the copywriting for your website on ChatGPT on the free account, I believe, right? You don't even have to pay the $20 a month. And I think that's a really amazing thing, but it does take a lot of mental gymnastics to say, I started a company in this age and the world looked like this. The world is drastically changing, 180 in many ways, right? And I think most people try to say, I wish the world didn't change, but that's a statement that isn't true, right? It has changed. I think the best founders given it's changed, I'm going to go tinker with a bunch of stuff and supercharge my business. And I think that's the thing that is going to be really exciting, that the founders of, call it this era, will actually look very different than like the Uber and Lyft era and then the era before that.
I mean, the speed to build also is just
Exactly.
that much faster.
Exactly.
Yeah.
Yeah. To your point, Saxon, I think two things could be true at the same time, right? One is the next two vintages, or 24, 25, would be better than 21, for sure, 100%, looking back, I think. But I think the second point, though, is timing in this business is so hard, right? Exit timing, how do you know when to get out? We've had a lot of public positions, had we known probably some of the positions we should have just gotten out in 21 at the peak, but nobody knew. When do you deploy? Those are things that are very hard to understand. So I think the best playbook for an investor is really just deploy, right? Find the best company, know your spot, pick a spot, and just go after the best founders and companies. And that's what you can control, to be honest. Versus like, you bet 23 is gonna be better than 24. Like, what if 24 is better than 23? It's very hard to
It's hard to pick. And the strategy typically for an investor should be stick with every vintage if you can.
Exactly.
And then you get the ups and the downs just like any market,
Yeah.
right? Something that is obviously the hottest topic out there, and I'd be remiss not to bring it up today, is ChatGPT, what we're seeing, generative AI, just some amazing new products out there. What are we excited about? I mean, is it AI, is it ML? What are we really excited about over the next few years in terms of verticals and investing?
Yeah. So it may not be the answer you want, I guess, but there's a lot of things that I'm excited about, but I really get excited about really boring old businesses that nobody is in. And it's always been the case. I was here last year and we talked about Web3. And a few years ago, ML, AI was a thing, and then it went off the thing, and then it's like crypto, and then went off. And so I feel like every year there's something. And my background, I worked at Goldman Sachs for nearly a decade, and I helped construct portfolios. And it was always your core portfolio that was always consistent. And then depending on the market, there was changes in sprinkles of the portfolio or certain allocations. And that's really how I think about it. I think about our core portfolio, what investments we make in the sectors that we make, and we have a thesis around that. And then, right now we're seeing an uptick in AI in fundraising decks, and then last year we're seeing Web3. But just to give an example, we invested in a company, it was a marketplace for art. And at the time, this was back in 2019, they were building an underlining technology to track the value of the artwork. And they were building it, and I'm like, okay, well, the core part of the business is really interesting around art and the way people buy it and Gen Z and all that. But she was building this technology, and then she was getting revenue, but then over time Web3 became popular, and then it's like, oh, now it's the thing. She's like, well, I've been doing this for a while, and then it was NFTs.
I've been in the space for years.
Right, and she's like, I've been in the space for years, and so it all of a sudden became attractive. So I think there's a lot of businesses that have been building AI for a long time, and that takes time to collect all this data to actually see real revenue coming from it. And so when I look at it, I'm also cautious around, like, is this something you just added because this is something that's hot and it's fundraising?
Put it on your deck and
Right.
you get a better valuation.
Exactly, yeah, or you get a meeting, right? Or is this part of the
Absolutely.
core business, which we kind of have to sift through. So for me, it's there's a lot of interesting pieces around that. Right now, we're looking at a truck as a company that sells into the trucking companies and OEMs, and they're looking at safety using AI. And the CEO is a data scientist, and she's been working on this for years as part of her research and IP. So she has a lot of data around that. But now she's partnering with the companies that have the hardware behind it, and to be able to say, all right, maybe you're not falling and you can't detect it right away, but we've tracked your symptoms over time, and we've noticed your heart rate is lower today. We're noticing your temperature is up, so they can predict if something's going to happen ahead of what's currently out there. So that's stuff that I'm really excited about, because it's like, this is health. This is something she's been doing for a long time and has data around it, and she has pilots that are paid. And she's still pre-seed.
Love paid pilots.
And revenue,
Love,
yeah. But this is something that's really exciting. So for me, I guess I wouldn't say a specific topic just yet. We like old, boring businesses where you can take market share and no one else is targeting. But we're also looking at exciting pieces around new technology that is being used in old industries like the trucking industry.
Awesome.
Yeah, one of the things as Samara was talking about was interesting is there's a difference between technology and business. Right, like if you have this amazing tool, but then it never gets used or applied in the correct way, I don't think it could be a venture scale business. So one of the things I'm excited by, like on the sort of AI and emerging tech kind of train is like, if you think about the traditional idea of having a business, right? You aggregate a bunch of capital, you have a bunch of departments that do those jobs. Now you could be a really awesome creator, or you could be someone who kind of knows how to code, but knows exactly the business they want to build. Like you might be able to line up and take your shot now because of the fact that all these technologies are available. And remember, these technologies are not linear, right? They're every time they come out, it's something like exponential. And I think that then empowers a bunch of people who might have thought about building a business but cannot raise around to say, well, I could spend a couple months trying it for relatively low cost, which then I think opens up the experimentation. So I think a lot of my excitement is not in the core technology, right? I think, Eric Schmidt was saying this morning, like maybe 1,000 people in this country really understand AI, right? And prerequisite is a PhD probably. And so rather than trying to invest in technology, which is what I think happened in Web3, when a lot of people didn't understand like blockchain and consensus mechanisms and all these kind of technical things, I think use cases are important because use cases are solving problems. And again, when you solve problems, you could build a business, and when you could build a business, you could generate returns.
It's got to be applicable.
Exactly.
Not even
it's that simple.
Absolutely.
Yeah, I think for me, again, agree with the points that you guys just made. I think, in the short term, obviously we are probably still going up on a hype cycle here for AI. I think this is probably the most disruptive thing that we've seen since the cloud. I think this is going to be the biggest thing for decades to come, to be honest. I think in the short term, though, today the way we build generative AI into apps, I haven't seen very novel ways of people integrate Gen AI into apps just yet, right? It's like the analogy I use is when mobile first came out, everybody's like, oh, I need a mobile strategy. I need to back a mobile company. This has not changed until, Facebook came up with the newsfeed concept, right? Like newsfeed wasn't a thing. Like you're not supposed to scroll like videos and then pictures and whatnot through. We have not hit that moment for AI just yet. Now, I think the AI use case today is actually very beneficial to incumbents, right? Like if I were Microsoft, if I were Adobe, if I were Salesforce, if I were SAP, I add AI to my current existing tool, and I make the underlying workers 10 times more productive, right? And I can create more value from it. So from that perspective, I'm not super bullish on sort of, hey, I'm doing the same thing, but just with AI, right? I'm looking for a new approach to how folks create value from that point of view. So it's almost like, to Liang's point about business problem, right? Like the 1,000 people you talk about, like I probably talked to a lot of them, all the big model players. I think, especially in the Valley, there's so much about engineers build a tool that engineers love using, right? Mm-hmm. It was super undervalued because nobody wanted to back engineers. Now it's everybody who wanted to back engineers. So I think it's almost a little bit like I would rather find somebody who's been in healthcare legal for 20 years and they know all the underlying SaaS system. They know all the software companies you guys have never heard about. And they're like, by the way, I can build a very simple workflow from A to B and just use OpenAI or Cohere or Anthropic, one of the bigger models, to empower this workflow, right? So to some extent, it's like the legacy workflow, like what's in it, that's probably the bigger value prop today than pure, I've got a better model than Microsoft kind of play.
I just want to add a quick thing, because I think every technology revolution, what's interesting is like, when the car steam engine first came out, it's like, oh, let's put the wheels on the horse and make a faster horse, without thinking that like now we have this thing called a car that a lot of people own and disrupt like transportation. I think right now AI is like, let's have better writers, right? But I think the future thing is something like we can expect. It's changing how we work.
Agreed.
And so that's like two different things. Yeah.
Well, that is all the time we have today. So thank you so much to the panelists. Please give it up. And real quick, Samara, what are the two Miami companies that you guys are investing in?
Blanket and Papaya.
Awesome. Well, we'll look for them. Thank you all. Have a great day.